Welcome to Fun with Annuities with your host, me, Stan, the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities. I'm your host, Stan, the Annuity Man, America's annuity agent. Yes, you're right. I am licensed in all 50 states. I'm glad you asked. Welcome to everybody on the major podcast platforms and all you aggressive people watching us on the Fun with Annuities YouTube channel. Today is a special day because we have a repeat guest because he's a smart dude. He's a personal friend. He's taught me everything I have ever known about the stock market way back in the day. That's how much we know each other. Welcome back to Fun with Annuities, the Honorable Owen Schrum.
It is so good to be back here with you, to be back with your listeners. We've gotten good feedback from the previous.
Yeah. Well, that's because you've been right. You know, I remember the first one we did, and you were my inaugural celebrity guest on the Fun with Annuities when we made the idea. Had the idea to, okay, let's bring on smart people. And I said, I know one. And you were the first one. And I remember I was getting so much heat about Bitcoin at 60,000. People were hammering us, yelling at us, emailing us. And Owen, give the people an update on Bitcoin from 60,000 to 20,000?
21,000.
Exactly. So, and at the time of this taping, we're typically a couple weeks out. So who knows where it's going to be at this point in time. Let's just start there because, you know, the pioneers take all the arrows, Owen, as we always say. Where do you think it's going? Bitcoin. Now, not Bitcoin, but crypto in general.
Crypto, okay. Exact. Crypto in general. You know, an interesting thing is I've noticed, and people are talking about it a little bit, and Stan, the Annuity Man, it fits right in with what we talked about. It was supposed to be the new currency, the new digital currency that people
alternative asset, Owen. It was an alternative asset.
Well, here's what happened. When the market collapsed, what happened to Bitcoin?
Went with it.
It did too, lockstep, almost. Yep. If you put the charts right beside each other, yep. They went up together, they went down together, only Bitcoin did so more fold. Much faster rate of decline. My point is, it's a risk asset like we talked about. It's not stored. It's not stored value. It's not the new currency. It's not the new monetary policy that countries are going to use. It is a risk asset with no implied value that is tracking just like other risk assets.
And with each passing day, there's like the onions being peeled back on bad stories. You know, lack of liquidity out of supposed crypto banks, you know, Elon Musk selling all of it. Institutions I read the other day really getting out of the crypto space. And I read the other day, and this is the one that disturbs me, is over 50% of crypto owners have owned whatever crypto they purchased for less than a year. These are newbies in here. These are people that are hoping and dreaming and buying the lottery ticket, don't you think?
You know, Stan, I saw, and by the way, excuse me, these numbers are not going to be exact, but the point is close enough so the point is made. They tracked crypto ownership. Institutions, typical investors, institutional investors, small ownership. They do have some, 8, 9%, 10%. A number like 55% of new investors under age 40 own crypto. So it is a new asset. The same people I fear are buying crypto that are buying GameStop and all of these high speculative meme stocks that we've talked about. And it's going to end poorly for them, and they're going to get a bad taste in their mouth, and they're going to avoid what is indeed a great creator of wealth, as we know, for generations of people because they got burned on crypto. They're not going to invest, and it's going to end poorly.
Yeah, I was talking to Paul Merriman, which is a good friend of mine. Sorry, I had to grab something. So for the people on the podcast on the YouTube, I kind of did a lean to the right. And he was talking about people that are investing in crypto have more faith in crypto than they do the S&P 500. And I was like, really?
Wow,
That's
I did not see that.
insane. That's crazy. That just means we're not doing any type of financial education in the school system.
Well,
But
that's a terrifying statistic.
yeah, if that's true, let's just say a portion of that's true. I mean, let's just say just a few people believe that. That is absolutely nuts. And I do think that, the Warren Buffetts of the world, they just think it's going to zero. Do I think it's going to zero? I don't know. Who knows? Do you know? Nobody knows. But I do think that watching it from a resistance level standpoint and what you taught me about watching those things, you can see it struggling. You can see the struggles right here. And it's going to test, I think it's going to test even further down and test the heart and soul and the guts and the, of people that want to hang in for the long term. So
well, I think it's safe to say to your listeners and to you involved, it's a risk asset. But for those who are looking at stable coins and the ones that are using for a money market deposit for their first home, stop. Please.
Please stop. Just
for your own good, stop.
No, I totally agree with you. Let's pivot to the markets. We're talking to Owen Schrum. If we'll have his site on our site, he's going to have a permanent page. It's Schrum PW, SCHRUMPW.com. If you want to, get a free portfolio review and talk to him, schedule a time with him. He is recognized as one of the top personal, fee only money managers on the planet. So if you want a high level brain working on your non-annuity assets, this is the guy, because there's a lot of charlatans out there. And as Owen and I always joke, we have cowboy boots older than most financial advisors. They haven't seen down markets.
They haven't seen inflation.
They haven't seen inflation. They haven't seen down markets. They really haven't seen volatility.
No.
So, I was talking to someone the other day, and I'm not going to mention the big firm. It's one of the big firms that is a big mutual fund firm, and they have a private wealth area. And I said, and they told me what the person said. It was the typical buy and hold and this, historical returns and all that stuff. And I said to him, how old is that person? Just wondering. He said, I think he's 28. I said, 28? All right. I mean, I'm not putting that down. I was 28 at one point in time. You were too. Oh, it's hard to believe.
I wouldn't have invested with you when you were 28.
No, heck no. Heck no, absolutely not. And vice versa, by the way. It's just that you have to, I'm not putting these people down, but you have to factor in who you're talking to.
Yes.
And the fact that they're young skulls full of mush and they're being fed a line to say, and you have to filter through that. I also think too, Owen, that people just need to be aware of risk. I think that's what I love about what you do, which is that's your primary focus, is de-risking the portfolio for growth. Am I right about that?
It is de-risking it to the person who's investing the money. And risk, as you know, you are on the front lines for a long time. Risk means different things to different people.
Sure.
We've got people out there that say low risk is non-NASDAQ tech stocks. We've got other people that say high risk is a 5-year CD instead of a 1-year CD. I bring that up only because risk is very specific to the person that we're talking to. So our first and main objective is to get to the bottom of what they're trying to do enough so we can customize this portfolio to get the returns they want, the goals they want, without taking undue risk that they don't want. Unfortunately, I speak to this as an industry, it's a fact. Our definition of risk is a lot different from the people we're talking to. There's somewhat of a disconnect. And what we think is normal, when we have the first bear market, people will look at their statements and they just can't believe that their investments could go down 15%. So communication and making sure you're in line with the risks that the client wants to take, and then hopefully deliver the returns and deliver that risk management. So again, the answer is it's person to person, family to family.
By the way, that's Owen Schrum. And one of the things that Owen has beside his name, other than graduated from the University of North Carolina, God's country, is he is a certified investment management analyst, which is a CIMA, C-I-M-A. There's not many of those dudes out there. You've got to go to Wharton and get, I mean, it's impossible. And of course he aced everything and he's got it. But the point is, this is high level stuff. And I know he sounds like your typical North Carolinian, and maybe he is.
I am.
But you know, there's some definite IQ there. When you talk about risk being personal, do you agree that inflation and the way people look at inflation should be personal as well?
Inflation. Ask anyone. During election year? What's the big rallying cry? We don't want to raise taxes. We want low taxes. Inflation is the most insidious tax there is. It's a tax on every American. This year, and you ask people going to the grocery store, they're not going to be surprised at what I say. Inflation is running almost double digits.
Yeah.
Increase in 1 year. How much would people be screaming if their taxes went up 10%?
But I also tell people too, turn off the television and what people are talking about with inflation, because if your kids are out of the house, you're not buying milk and taking them to dance class and practice, you're not driving as much. It's personal. It's personal. And also too, if you have enough assets, you're watching inflation like the Romans watched people fight in the Colosseum. You're up there eating grapes. So when people start going, well, inflation, how do we solve for that? I'm like, what are you talking about? You know, stop being dramatic. You know, inflation always hits the lower end people, unfortunately.
It is
a lot harder. It is, but I'm tired of people, and most of the people that are listening to this podcast are people that are investors, are pretty well off, are trying to get better, understand markets. Please stop trying to find things that are going to solve for inflation. It's not there. And if anyone tells you they have it, run, get up, walk out. There's no packaged product that does it.
The key, however, to inflation, and to the point when I say it's a tax, it affects people's wealth. Unfortunately, the best way to beat inflation is to have assets. And people with assets, their assets are inflated as well. And there are certain asset classes, certain things you can invest in on a general basis that do much better during inflation than other things which suffer during inflation. You want to own real assets. There's a lot of real assets. Dividend paying stocks are real assets. Stocks are real assets.
Right.
Everyone thinks the stock market is Wall Street and the stock market. No, it's not. It's a business on the corner.
That's correct.
It's a plant making something. It's a company writing software. Stocks are real assets. Commodities are real assets. Real estate is real assets. Inflation, real assets do better during inflationary times. Financial assets, not so much so. They tend to do poorly and don't keep up with inflation. Financial assets, bonds, CDs, holding mortgages, anything that is a financial asset just tends to perform poorly and underperform during inflationary times.
Let's talk about bonds, Owen Schrum. In a rising interest rate world, and unfortunately, a lot of people think bonds are safe. There's more bonds than stocks, and it can't, you know, valuations can go up and down. What are you telling people here about bonds in the world that we're in?
Bonds, first off, I'm going to answer that backwards. We've had the longest bull run in history in bonds. Bonds have gone up in value since 1981. Tell me a bull market that's gone up that long. That bull market is over, and it might be over for the foreseeable future. Interest rates sitting at the pre-pandemic, everyone was 0.2.
Yeah.
In the pandemic, they lowered it to darn near zero. Which way are rates going to go? Now, in the same period of time, because I was going to talk about inflation, Milton Friedman, the great economist, said inflation, period. What causes inflation? Forget the economic mumbo jumbo. It's monetary supply, money, M2. Did you know we created $10 trillion plus of money supply in the past 2 years? Over $10 trillion.
Did we run out of toner, Owen? Is there an investment play on toner cartridges?
Unfortunately not. If they did, they'd be selling it in Argentina and Chile. But I'll give you a point. Normally we increase monetary supply in this country. And I know I'm in the weeds, but know this, because it'll make you understand everything better. Believe me. The country, we increase monetary supply 2.5%, 3.5% every year. That's what they do. That's what the Fed does. How much does inflation run every year? Normally, 2.5%, 3.5%. We just increased money supply 40% in 2 years. You wonder why we're having inflation? And that money is going through is in people's pockets. It's not in banks and insurance companies and institutions. That money went into people's pockets. And unfortunately, it takes a long time for that to work its way through the system. So inflation isn't transitory
oh, come on. Miss Yellen said it was.
It's not transitory. And inflation from 2 years ago that started is going to take 18 more months to work its way through the economy because of the way they do the reporting. Real estate is a lagging indicator.
Yep.
We're starting to report on real estate sales that happened during the peak of inflation. So inflation isn't going away.
Also, the job numbers are lagging as well. They're out here touting job numbers. I mean, that's a lagging indicator. You're a smart guy. I mean, obviously you're my friend, so you're smart, right? And you got your MBA you even went to Hampton-Sydney College, for people that understand where that is. And we're going to have to discuss why you have a chemistry degree from Hampton-Sydney and how that applies. In fact, let's stop there because I'll hold the question. You have a chemistry major.
1980, as you know, without going into history, poor boy from North Carolina. Jimmy Carter was the president from 1976 to 80. Unemployment's 10%. I had 12. We're stealing coupons from calendars so we can get 2-for-1 Pizza Hut to live on for the week. No money. Art history, not to knock it, art history and
I took that class, by the way, and I made
it wasn't an option. I wanted to take a degree that I could get a job when I got out of college.
And that job was with one of the best employers on the planet and who I kept in business for many years until I stopped, and that employer was?
Well, I worked for Nalco Chemicals.
No, that's not what I'm talking about.
But our biggest client that I worked for was Anheuser-Busch.
There you go. And when I stopped drinking, Owen, their stock went down.
In fact, they sold out to a Brazilian company, Ambev.
Oh my God. I know. But I was like, man, you were the chemist for Budweiser. That's phenomenal. But you're a chemist, but I think that you being a chemistry major separates you when you manage people's money. I'm going to go out on a limb, Owen. There's got to be less than 5 of you chemistry majors out there managing money at a high level. Am I right?
Has anybody ever watched CNBC in the audience? Have you? I know you have.
I'm raising my hand just because I laugh. I laugh at how they promote crypto as the crypto ads are coming up. That's all.
Funny guy in the morning, Joe Kernan.
Yeah. Is he a chemistry major?
Chemistry major from MIT.
Oh my.
Then biochemistry major. Master's from MIT, and went to work for Merrill Lynch.
Oh my God, sounds eerily familiar, Owen.
It does.
Unbelievable. Well, that's interesting. I got sidetracked with your background and your resume because it's fascinating. And he plays guitar. And Owen played football for Hampton-Sydney. And I'm not sure what I'm getting ready to say is racist or not. If it is, stop me. Okay. Because it's not meant to be racist. But before the knees gave out on you a few years back, you were a fast white guy, correct?
Yeah, that played defensive back for the sole reason that I could run fast. That was
those days are gone. Those days are gone, Festus.
I could
tell you that.
I could unfortunately pull my pants up and show you the 2 scars on both my knees from knee replacement.
Please don't.
Fix that.
Well, what I want you to return to on a daily basis is wearing the headband that you used to sport a long time ago, because I think you could throw your logo on. You know, I'm about logos. I'm wearing a hat. You could wear a headband. I mean, that would work. All right, let's pivot back. They're redefining recession here, Owen. I mean, I was under the assumption that the recession definition was pretty locked in for the last 100 years. The administration this is a rhetorical question. Do they think we're this dumb?
No, I cannot believe. Look, I got to be agnostic politically here, but I cannot.
Of course.
I cannot. In fact of honesty, I gotta come forward. The Biden administration is right on this one issue.
What is that?
They're trying to say that the definition of recession of 2 negative down quarters of GDP is not indeed the definition of a recession. And in this one case, they're right. It's
but lazy. What's the asterisk to that, though?
Well, it's a combination of a lot of indicators. In fact, the negative GDP is sort of, as we talked about, a trailing definition. I was pulling something up. I actually saw this.
Don't show it, because 99% of our people are on podcasts.
I understand. I'm just going to read it. It's a lot of indicators. Aggregate real economic activity, federal statistics, real personal income, non-farm payroll, unemployment is measured by household survey, unemployment, non-farm unemployment, GDP. So there's about 8 to 10 things that make up whether a recession is in place. So to say that 2 negative quarters of GDP, by the way, which routinely they revise those every other quarter.
Aren't they splitting hairs here? Aren't they trying to thread the needle? Come on, man.
I'm going to put it this way. You're not having a recession when you're having, economic activity, industrial production was up 5.5%. Average new jobs was 450,000. That's not recession. That's not a recession. We are, in my opinion, going to have a recession. It's just not one right now. A recession is going to come. The Federal Reserve never, I cannot think, I've done this since 1983 and studied it for 10 years before that. I've never remembered a time that the Federal Reserve ever was able to orchestrate what they define as the soft landing, where they raise interest rates just to slow the economy down. And they don't push it into a recession. In reality, it's not that easy, and they never do it. So they're going to raise interest rates. They raised them yesterday, 2 days ago, 0.75 basis points, 0.75%. They're going to do it again. They're probably going to go too far. And in sometime in 2023, 2024, they will push us into what I think will be a rather mild recession. But I do think we're going to see a recession. I just personally don't think it's now.
Shameless plug right here, Owen. I want the people right now listening and viewing I just want you to think about who you're dealing with from a money management standpoint. And I want you to think and analyze, are they as smart as what you just said? I mean, do they sound like Owen? Do they talk like Owen? Are they as smart as if they are, fine. But I'm going to tell you, I need you to think, I mean, he's a good friend. Yes, I'm plugging in, but he's fantastic. The point is, you need to have an advisor in the non-annuity space that you can have this type of conversation that Owen and I are having. A non-salesy, high IQ, pragmatic approach to your specific situation. Okay, I'm off your soapbox now, Owen. But I get mad sometimes when people go, well, my advisor, I'm like, then get a better advisor. You know, it's like you go to the doctor and say, my arm hurts when I move it like this. The guy goes, well, then don't move it like that. I mean, it's the same thing. If you don't feel comfortable that your advisor has the IQ level you need, find another advisor, okay? Maybe it's not Owen, but at least have the conversation with him. Ask yourself, could you have this conversation that I'm having with Owen? Because this is the conversation you should be having with your advisor, which is about the markets, et cetera, et cetera. Pivoting just a little bit, Owen.
Okay.
Our friend Vladimir Putin and the Ukraine issue. the Biden administration is saying that it's having more effect than most people believe. Are they right? What is your take on this ongoing war that doesn't seem to end, and now the media's lost interest, so now we're not hearing about it anymore?
I have, again, this is one person's opinion,
Sure.
but I follow a lot of other people. So this is less my opinion than my aggregate gathering information from people smarter than I am. And it's to the point you make. Already France and Germany are bailing. They're going to have no heat. They're going to have no natural gas for the winter because they ditched all their other energy supply to sell their soul for the Russian Nord pipeline. Germany and France are bailing. Who knows what the current Biden administration is going to do? And Russia's going to take a long. I have a concern that we're just going to. The longer it drags out, the less interest this country is going to take in it.
Yep.
And Russia is there, and let's face it, he doesn't have to worry about a population kicking him out of office.
No.
They can sit there, and as we've seen, he can keep manufacturing military goods and starve the country, but I just don't see him stopping the bombing of Ukraine. And at the very least, Russia will end up taking the eastern seaboard coastline grain areas of Ukraine before it's over.
Yeah, I think the ripple effect is just starting with all of this. And I know, and when you send billions of dollars over there, there's people that are taking lots of that and just going to the Swiss Alps. I just haven't been invited to those parties yet. But I mean, you and I both know there's some shenanigans going on with that. Anytime you send that stuff, the military industrial complex, I sound like a cable news person. But the point is, me and you both know there's some agendas here that don't line up.
But another thing about this is maybe the most important thing to come out of this, other than Germany and France's ability to support NATO on their borders, is they've allowed Sweden now in NATO.
Yeah.
Finland's now in NATO.
Yep.
So maybe there will be a I mean, let's face it, NATO's been in my opinion, more of a diplomatic entity than a defense entity for decades. And maybe this will be redefining the NATO coalition. That may be something that's interesting that comes out of this. No longer is Germany and France the centers of NATO.
We're going in, it's always been weird times. I mean, everyone says, well, this is really strange and really chaotic. It's always weird and chaotic. But I think what scares me the most is that we really haven't had what I call an event in a while. And that would shoot this whole thing. That would throw this whole thing into chaos if there was an event, terrorist event,
right?
Those type of things. Something really bizarre that's unplanned. And I know people out there screaming at the speakers going, what about all these shootings in the country? Yeah, those are horrific. But I'm talking about 9/11.
Yeah.
Those type of things that just sends the country in a spiral. I guess COVID could be thrown as that as well. But I think as a country, we got to come to the conclusion that we're going to have the cold, flu, and COVID season from here on in. I mean, we just added one. I've had COVID 3 times. All different variants. I'm just getting off the third one. The third one was weirder because it was more of a cough than anything. The first one the first one was worse than the second one, etc. But I just think it's going to be part of our life going forward.
Stan, let's segue that into something that really may tie into people's investments a little bit, because which is what I know people really would like to hear about. But It follows what the vein you're speaking is. For a long time, late 80s, 90s, globalism has been the economic force of the century, of the past 50 years.
Yep.
The growth in China and emerging markets and South Korea and India and Brazil, global jobs from the United States shipping over to Vietnam to Asia. I mean, globalism is all you've heard about. Half the decisions that affect this country are made in Davos, Switzerland by the globalists. That's fact.
Yeah, it is.
There's a lot of people saying that there is now being a retrenchment of globalism, and we're all becoming more nationalistic because of the response to the pandemic, because of what's happened in the Ukraine. People don't trust the globalists because of what's happened. I mean, and we've talked about inflation. One of the major causes of that inflation has been disruptions of supply side chains.
Right.
And I hate to tell you, the reason there's been disruption of supply chains is because we get it all from Asia. That wouldn't have been a problem for domestically produced goods.
Right.
And you're starting to see more. We just passed a giant bill in Congress to make all our chips, $400 billion?
Yep.
Start making all our chips no longer in China and Asia, but in the United States. Again, maybe we will see the world become smaller. I'm not saying it's a good thing or a bad thing, but it will affect your investments, because if you're in a pension plan and you're buying target date funds, or you're buying, and you're in a lot of the annuities people buy that have the predefined investment portfolio.
Yeah, the variables. Yep.
Look in them. I'm going to bet you 40% of the equity portfolio is international. And I believe that there may be some disruption of this global economic theme that has happened, and maybe there's opportunities right here in the United States.
What does that mean for a portfolio? Are you less global with the portfolio, or are you more targeted if you're going to do it?
That's a really good question.
Of course it is. Because I asked it, for God's sake.
Well, if you look even 2 years ago, McDonald's earnings were down 12%. A lot of companies took big hits because they pulled out of Russia.
Right.
Starbucks and some computer companies and even Apple are retrenching out of China a little bit. They're moving manufacturing facilities out of China. So maybe the theme is the United States going to reindustrialize? Are we going to produce more important strategic goods such as technology in the United States? And is there an opportunity for domestic investing versus international investing? I think every investor and every manager needs to decide, is your allocation standard global mix for a diversified portfolio and a pension plan is 55% US, 45% the rest of the world? Should that be 70-30? I think it's decisions people have to make. Look, let's stop this looking backwards. This fund has a great track record going back testing
numbers in annuities or investment. It's a joke.
What's important is forward thinking.
Correct.
Maybe we need to make some forward thinking decisions and reevaluate asset allocations, both from a risk and from a return point of view. And maybe a portfolio heavily weighted in domestic might make more sense from both a safety point of view and a return point of view. Don't know, but it certainly begs discussion.
Oh, and as you know, there's a group called Pearl Jam, and they're a very good rock and roll group. And they have a song called Jeremy. And it says, one of the lines in it is, Jeremy spoke in class today. Go pull it up for the people that don't know that song. But the Jeremy I want you to talk about is the Jeremy that you follow.
Yes.
Can you tell the people about that Jeremy and what he's saying right now? Because I know that you interact with him and you follow him, and he's pretty insightful. What is Jeremy saying? And tell the people who Jeremy is.
Well, let me back up. Dr. Jeremy Siegel is one of the great economists today, a major influence in the world economically, more importantly, and I'm not going to give him the name, but people have said the Wizard of Wall Street. He wrote the definitive treaty on the history of returns that's used in every academic environment, stocks for the long run.
But do you think he's ever been introduced with Pearl Jam like I just did?
You know what? I went to his house, a high-rise company.
I mean, that's a pretty good segue. You got to admit, I brought that one.
You know, and he would love it. He had when I went to see him, a 10-year-old son who had guitars, including Pearl Jam. He loves Eddie Vedder. He
Okay,
loves Eddie Vedder.
okay. So he would be like, "Yeah, Stan, you're on it, brother." That's what he'd probably say, but in a
But what
very probably more highbrow way. So keep going about Jeremy.
So what did he say? As you remember in your day, he was the one in 1999 who stood upside down on his head and said, anybody buying NASDAQ right now instead of selling NASDAQ, there is no such thing as the valuations that these stocks hold, and it's a bubble. Most did not listen to him. Last March 31st, I think, was the date of 2020. He got on a call with all of us that are fortunate enough to have access to him, and said, you've got to get on the phone and tell your clients, whatever they do, do not sell your stocks, because I've never seen anything like the monetary supply, money supply hitting this country right now. It exceeds World War II levels. They're flooding the market, and eventually these stocks will buy back, if not for any reason other than the amount of liquidity in the market. Tell your people not to sell. And that literally was 1 week within the bottom of the market. As we know, it bounced off of 34% and finished up the year 11%. Dr. Siegel then during that same call said, we are going to have inflation. Inflation will rise 20 to 25% in the next 4 years.
Wow.
And he said it then, and he's beat the drum. He's also said the bull market and stocks are over, which I never finished that. Stocks about fixed income, the bull market and bonds are over. Rates are rising and will rise for the next 3 to 5 years. You will, depending upon the maturity of your bonds, you will lose money in bonds, because remember, bonds.
Wait a minute, you just said lose weight.
Lose what? I know.
I know it's in your mind because you're so skinny. I think you threw that in there subliminally.
I'm looking at Stan.
No,
here.
wait a minute. You just threw that in there just to throw it in everyone's face that you've lost all this weight and you're svelte, which is one of my favorite words. All right, keep going. Sorry.
Okay, good. I want to loop back to that. People who buying stocks with maturities 3, 4, most maturities in a portfolio are 10 years, are going to lose 8 to 10% of their money in bonds.
Mm-hmm.
He has beaten that drum, continues to do so. He says right now, interesting that he's when the stocks are off 24%, he says we're within 4 to 5% of the low. If we've not already reached the low, I believe there'll be a rally year end, and we'll have a recession next year. And gave us some interesting data on midterm elections I'd love to share before we hang up.
Please do.
Interesting. He believes that people investing money at these levels, particularly in some of the lower, the Amazon, Netflix, PayPal's, Tesla's of the world may be down 70%. There are a lot of blue chip stock, and they were trading at 30, 40, 50 times earnings in just unsupportable levels.
Right.
But as stocks have sold off, so have the more reasonable value stocks with good dividends, and they're trading at 10, 11, and 12 times earnings, Dan. There's people deploying money in inflationary times in these stocks, historically will have really attractive returns if they have a long, and I'm not trying to say the buy and hold thing, but let's face it, the old saying is buy low, sell high. Well, right now it's lower than it was 6 months ago.
Right.
And when you're looking at some reasonable stocks at 13 times earnings, historically that's a good entry point, and you probably will have good returns. That's what he's saying. He also is saying inflation is going to continue to run high for 18 months, only because it's in the system and has to work its way through the system, but the Federal Reserve has to be careful not to go too far.
What I like about what you do is you're data driven.
Yes, we are.
And I can summarize that with facts, not emotions. And I think people need to realize that it needs to be data driven. Everything in life is data driven, whether you know it or not. The advertisements that come into your phone are data driven. The food that's on the shelf in certain spaces is data driven. Everything's data driven. So if that's the case, then why aren't you more data driven with your investments, and why aren't you with a data-driven investment advisor, money manager, guru, master of the universe? Because there's no emotions with this. Yeah, if you're, if you want to do emotions, then go be a trader and good luck.
Mhm.
Okay, but I think what you need to take away from this is a fact-based business. Investing, it's facts. Institutions don't make investments based on emotions. They make investments based on facts, and they have to have all the facts, not some of the facts. There's no emotion in that. So I think that's what I really like about what you're doing. What's worrying you right now, Owen Schrum?
The
Other than Carolina basketball. Stop for a second.
That's not worrying me.
Okay. So you have recovered from them losing in the national championship.
That is not worrying me. What worrying me right now, twofold, is people are still holding too many bonds in their portfolio, and they don't understand the risks. They don't even know that they have them. I'm not being investment specific, but the most popular investment in 401k plans, of which there are billions out there, are target date funds.
Mm-hmm.
And without going into the details, if people want explanation, I'll be glad to talk to them. But target date funds balance stocks and bonds depending upon your retirement. But the pertinent word is they have bonds, and usually the maturities are intermediate to long-term bonds.
Sure.
And without even knowing it, 40 to 60% of their portfolio could be in longer-term bonds, which one, they're not going to get any return. Most likely they're going to get a negative return for that percentage that's in long-term bonds. And I don't want to, Americans are wonderful, hardworking people. I don't want them to see them lose money in the 401k plan when it's so obvious. So that's number one. Number two, I am concerned the Federal Reserve will go too far and force us into a deeper recession than we would normally have. I believe we're in good shape as long as the Federal Reserve doesn't go too aggressively. They've been pretty aggressive, and I'm looking at the money supply, and the faucet's been turned off.
Yep.
It's been turned off. The money that's working its way through will run out eventually, and they've just got to be careful. Those are the two things that are worrying me.
It's hard for me to believe that the Fed, at the time of this taping, they just raised rates, and then I guess the next scheduled meeting is in September. It's hard for me to believe they're going to raise right before the election. What's your take? Not saying that none of us know. What's your insight?
It was hard to believe by most people in this business, particularly the economists, and particularly the good ones, that they did not raise rates back when they had flooded the market.
Agreed.
With that money. And obviously we were starting to fly again. We had vaccines. People were getting vaccines. The economy was reopening. And they continued PPP loans. They continued unemployment loans. They continued economic stimulus. They put another $4 billion in as people were going back to work.
I know.
And Janet Yellen said herself, we should have stopped sooner and started raising rates. I would have thought they were then. One, it's groupthink. Understand, it's not just one person. It's a board, and the political spectrum of that board is varied. And I'll leave it at that. And so it was disbelief that they didn't stop earlier. So, yeah, I can believe they would go too far. Boards of directors don't make great decisions sometimes because they all have to please everybody.
That is true. What makes you optimistic? What's the glass half full? When other than your life and your friendship with me, music in general, but from the market standpoint,
I rarely stop counting my blessings for those that think of another thing.
But what makes you optimistic here from the investor's standpoint? I think you've laid out a lot of it, but tie that up in a nice little bow on what makes you optimistic.
First and foremost, without sounding corny, capitalism, the free markets, is the greatest system and has created unbelievable wealth for hundred years, and it's still unfettered, and there's still wealth to be made, and there's still hardworking people. And I'll give you an example. There's a lot of stocks out there that people loved. And as you understand from compliance, I can't name them in this.
Of course not. No.
You all know who they are. Some really great stocks that you loved, and they're 30 and 40% cheaper than they were 2 years ago, and now people hate them. So my point is, there are some really good companies at really fair valuations that if people just avoid the emotional construct of becoming one of the herd and panicking from all the news, and evaluate, rebalance their portfolio as they need, perhaps even dollar cost average into lower priced assets, if it's commensurate with their objectives. Look, if you're retired, you're taking income out of your portfolio, that's a different scenario. That's
Sure, totally.
Just from an investment construct, valuations are cheap. We believe this recession. Look, let me back up, Stan, to answer this in another way. We had the worst pandemic since 1917. It was global. Entire economy shut down. Many people thought we were going to shut down economies for years, not months. The pharmaceutical companies, the science community, the health companies rallied around, came up with a vaccine in 6 months.
Yeah.
Saved hundreds of millions of people's lives, and we're back to work in 24 months.
Yeah.
Now, that does not minimize the sadness of millions of people.
Sure.
I'm sorry.
Sure.
But it's miraculous what we've done during that period of time.
It's true.
And now we're going back. Try going to an airport. But you asked me before about, are we in a recession? Go to Atlanta Hartsfield Airport. Tell me about recession.
Yeah, every plane I'm on, of course, Owen, I'm in first class. You understand that, right?
Yes.
Because it's not because I'm wanting to spend money. I'm tall. I'm not vertically challenged like you are. I'm 6'6".
I sat in a plane with you when the guy in front led his seat back all the way.
That's when I couldn't afford first class. I got a couple more questions for you as we tie this thing up. Obviously, I always have fun with you, and even though you're a really good friend, one of my best friends in the world, I always enjoy and look forward to what you have to say about investing, because it's always enlightening to me, because you just know the stuff backwards and forwards. Tell me about what your feelings are about consumer debt here, because we're revisiting those 2008 levels that, we're never going to do that again. We're there again with consumer debt. What are you thinking about that right now?
It worries me a lot for two reasons. The people taking on the debt are the people least able to afford it.
No doubt.
And it's furthering the schism we have between the have and the have-nots in this society. And that's not the history of this country. Something like the consumer debt is what is making that gap wider, and that bothers me. Secondly, guess which rates are going to go up faster? It's not the rate the bank's paying you on your CDs and savings accounts. It's what they're charging you on loans. Yeah. And that rises exponentially the more risky those loans are. The payday loans, the credit card loans, the mortgages. I mean, Stan, did you know some of these payday loans, the interest rates are in the hundreds and some of them are in the thousands?
It's ugly, man. It's ugly. And I mean, that's an ugly business, really.
And credit card rates, lucky if you see 24, you might be looking at 34%. You can't get.
But we're back there again.
And it worries me for the people. It worries me for the country.
It does. And we both have been, we both come from no money, and we both have been in those situations where we didn't have money. We've been there.
Yes.
It's a hard thing, man. And you do what you got to do. Right. And so the problem is there's a lot of people having to do what they got to do to survive it, whether they're on their own or have a family. One last question is always the last question with my celebrity guests like you. There's no pressure whatsoever, Owen, because, it's just one question. But it's the mic drop moment, and I'm gonna give you the floor once again to leave the people with something when they turn the podcast off. They go, you know what, that guy Owen Schrum left me with such a nugget of wisdom that it's going to change my life. So no pressure whatsoever with that. I'll count you down. 3, 2, 1, go.
I want everyone out there that has a 401k plan to do a deep dive into, do they have any bonds in their 401k plan, and what are the maturities of those bonds? Period.
That's Owen Schrum, personal friend, financial guru, all-around good guy, mediocre guitar player.
Mediocre.
But he means well. And I want to thank every single person that's listening to us on all major podcast platforms and joining us on the Fun with Annuities YouTube channel. I will see you next week. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.